Hello, everybody. My name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using closed-end funds and an income-focused strategy. It isn't polished, it's not scripted, and it's not hard thinking. We don't chase headlines, we navigate markets. And I'm not a financial advisor, I am a strategist. I go where the data leads, even when that means walking alone. So, welcome back. It's definitely later than what I normally film, simply because it took a lot longer to get the week set up than normal for whatever reason. But today just seemed busy. It also took me a little bit longer to wrap my head around the data and how I would sort and implement the data this week. So let's get into that. So the currents didn't change this week, but the noise definitely got louder, and that noise created turbulence. The herd has been exceptionally skittish. We saw volatility almost everywhere: equities, precious metals, crypto, CLOs, and bonds. And that's not structural deterioration. That's emotional liquidity moving quickly. Sometimes we don't like that happening, especially when it happens in fear. When it happens in greed, we love it. But why the anxiety? Why is the herd skittish? The weak spike in volatility came from one reality or one realization. AI is not just software. The market had comfortably categorized AI as an extension of existing tech: NVIDIA, Microsoft, Meta, Amazon, Alphabet, the works. And then all of a sudden, investors began asking, what if AI replaces parts of the existing tech ecosystem? That question triggered knee jerk selling, caused a lot of panic. It wasn't tariff level panic, but it was a good wave pool volatility. And that volatility likely isn't going away, not until policy clarity improves and the Fed becomes more consistent in responding to actual data. And honestly, until it's the market, but it's the herd. It's educating the herd that AI is not software and software is not AI, but they both need each other. But the problem at the Fed continues. So, what is the Fed doing? Not much of anything. They are reviewing data, but they're not reacting to data. Inflation is cooling, growth remains, jobs came in stronger than expected. Tariff revenues are exploding, they are exceeding projections. Yet rate policy remains frozen. We have a new incoming chair, and whether you love the Fed or want it abolished, one thing is clear. If the Fed exists, it must respond to data, not imagination, not lagging indicators, and not personal narratives. Cut when inflation is controlled, tighten when inflation runs wild. Stay on cycle, not 2 cycles behind or 12 cycles behind. Markets can handle clarity. They want clarity. They demand clarity. They struggle. We struggle with hesitation. So here's the actual backdrop. There is a lot going on. Partial government shutdown, dollar headlines are misinterpreting rate expectations. Jobs are stronger than January projections. Deportations continue. Ghost jobs are fading. Labor is not as soft as it's feared. GDP is growing. Infrastructure demand is accelerating. AI, data centers, energy, right? We need that yesterday. AI and software growth remain intertwined. Energy production is expanding, and yet we need it faster than it's happening. EV manufacturers are reassessing their subsidy revenue or their subsidy reliance, and regulatory rollbacks are reducing cost burdens on auto producers. That's really good information, but that's not recession data. That's transition data. On the closed-end fund side of things, whatever happens in the market at large, that volatility is amplified in the CEF world. Why? Because stocks are priced on perception, and closed-end funds are priced on supply and demand. If you're buying single shares of Coke and if they ever run out of shares, Coca-Cola can simply whip out a sticky note from thin air, write a share, create a share, and it doesn't impact the rest of the shares at all. But when in the closed-end fund space, when fear rises, liquidity pulls back and discounts widen. And when sentiment improves, premiums return. The closed-end fund space exaggerates swings because the share count is fixed. More sellers than buyers, discounts widen. More buyers than sellers, discounts shrink. That's not structural failure. That's mechanics. That's simply supply and demand. I heard it said earlier. I've read it in several articles that real estate doesn't swing like equities, but that's not entirely true because it does respond to the same forces: GDP, jobs, rates, inflation, housing supply, except it responds differently. So, with volatility rising, housing competition easing, and rate expectations stabilizing, real estate and REITs are beginning to look stronger. REITs may be transitioning from they're a bond proxy. So instead of simply labeling them a bond proxy status, they might actually be transitioning into their own category, especially as infrastructure and energy demands expand and the shift matters. So, where that leaves us, it may feel like a tropical system forming, but turbulence doesn't equal collapse. Markets are recalibrating in real time. Liquidity is rotating. Volatility is repricing the risk. That's uncomfortable, but it's not catastrophic. The currents are strengthening, not disappearing. And our targets remain unchanged. It's still bonds and bonds proxies with end-to-end energy and real estate becoming their own categories. Then we have technology beyond the mega caps, so AI, software, 5G infrastructure, all of the above. We buy dislocations. We are not chasing spikes, and we are not chasing reflections in yesterday's market. You cannot time the bottom perfectly. You buy the trough and you position intelligently during the turbulence. So, with that context set, let's move into the closed-end fund snapshot. And here are the top funds for the opening bell and why they made the list for the week. And I realize tomorrow is not the opening bell. I'm still making the video today to be consistent. And I know that as crazy as today was, and it being a weekend day off, tomorrow is not going to relent. So if I don't get this made today, it's not going to happen tomorrow. So as I share my screen, you're going to notice I have a lot more tabs up than normal for a reason. Too many bars in the way. See what I can rearrange here. So I wanted to look at some of these funds individually, but also show them in relation to each other. So this is the existing list, which is not going to be the final list for the week. I am going to sift and sort a little bit. USA doesn't make the cut. The ex-dividend date happened in January. If you buy it today, you're not going to see a dividend until June. And on my end of the things, I'll buy USA and its sister ASG. I like to buy them in tandem. I like to buy them when they are the best options and nothing else is above them as an option. But I also like to buy them when I'm going to see a dividend soon. And waiting 4 months to get a dividend just does not sound like fun to me. So that leaves us with this. DNP is not going to stay on the list. Its pricing for me is above my existing price point. And if you followed me for a while or you haven't followed me for a while, I don't like to intentionally raise my own cost per share. I'll do it when I have to, but I don't like doing it when I can buy something cheaper or buy something new. So DNP, though a great, it is. It's at a premium, but we're looking at its individual data specific to its fund. So it's currently at a premium, but it's also cheap compared to its own average premium. So even though it's almost 4% above, so it'd be like paying $1.04 for it. It's normally $1.06. So you're still getting it at a slight discount. So that leaves us with this list. So in times of volatility, outside of the data we normally cover, so we look at targets, we look at the overall discount specific to every fund. Is the discount significant based on the fund's history? And then we look at when they pay, dividend policy. Me, I like monthly payers, but occasionally we target funds that aren't monthly payers, ADX, ASG, and USA specifically. And I'm sure that at some point maybe we encounter another, but for right now, ADX, USA, and ASG are the three funds I own that I've talked about that are not monthly payers, but none of those are on the list for the week. So we've got significant discounts, monthly payers, and then we look at yield. And I try to target anything 9% and above unless there's a good reason for keeping it on the list. And for right now, HFRO remains on the list because it's one of the higher discounts. It's 44% off. So it's like paying 56 cents a share instead of a dollar. That's a really good deal. But in times of volatility, we really should be considering another metric that's not currently listed on the spreadsheet. We should be looking at the overall net asset value of the companies and who's consistent. Now, it's hard to be consistent and it's hard to raise your NAV in volatility, but some companies do. So I wanted to display it all for you as I walk through this. And I think I've got them all up here. So me personally, I like to buy BRW and FSCO as a set. And they are bond funds, but they're also bond proxy funds. And they're not what I would consider definitive lifetime bond anchor portfolios, I guess you could say, for my portfolio. FCO is a private lender BDC encompassed inside a bond company. And it's a US all-American company, which fits the existing market and for sure the next 2 to 3, maybe 4 to 7 years from now, depending on what happens after President Trump. It's a great timely buy for this market and the coming market. But it's not a lifetime buy because if interest rates rise consistently, then that BDC lender option kind of goes away. And it's great for right now, but it's not a fist bump solid for the rest of my life. BRW is similar. It's got bonds, but it's also an international company. So it's got bonds, but it also tracks closed-end funds and a lot of closed-end funds. A lot more closed-end funds than I track, and not all of their closed-end funds are on my list. It also tracks crypto and minerals and metals. And the crypto market, the crypto market would love to say it's deregulated and not connected to the US economical system at all, but at the same time, it is. Like if you own crypto, for the people who are dedicated to cryptocurrency, they really don't own anything else. But most people own crypto and real estate and stocks and bonds and this and that. And when things get rough and volatile, they sell crypto first. So for a portfolio that's built on closed-end funds, more volatile than the average stock market space, crypto, more volatile than the average stock market space, heavy metals, gold and silver, more volatile, mineral, like it's bound to see more volatility and more price swings. So even though it's more volatile in the sense that even though the portfolio has drug on value lately or dropped on value lately, and the NAV has dropped on value lately that I'll show for what it is, and this market and the coming market, it still remains a good buy. It just honestly depends on your comfort level and risk. Excuse me. So with the existing volatility we're seeing in the market and with the Fed doing nothing, right, that hesitancy is impacting the market with everything in their market, with everything in their portfolio just being more volatile than the mainstay market, it's dropping. But at the same time, it's kind of a great opportunity. FSCO has seen more consistency in their overall net asset value. It's down a little bit over a year, but it's not bad. HCLB, pretty on par. HFRO, wrong page, pretty on par. NBXG has gone up over the last year. PTY has increased over the last year, not by much, but it's increased. DLY, same thing. It's increased. It's probably increased the most over the last year. So knowing that, how does that shape what we're buying? Well, HGLB is higher than my existing buy price in the cash brokerage account. I will buy and increase that amount if I need to or if I have to, but my goal is to not do it intentionally. HFRO is a great discount, but same thing. It would increase my overall dollar cost average for the account, and it's got a lagging dividend. But even so, I would still like it's not my goal. If this were lower, I mean, it would if this were a lower price, yes, it would raise the yield. But even with a lower discount, I would still buy it. Even with the fluctuating NAV, I would buy it. I just don't want to increase my dollar cost average, my individual dollar cost average. And it's all about buying the best thing in the current market. So is it a great deal? At 44% off, yes. At 642, it's a decent price. You can go back and check the price in relation to where it's been. Overall price has gone up, right? Trending well. But for me, I don't want to increase my own dollar cost average. Oops, I don't want to insert. I want to take out the row and take out that row. So that leaves us with this. These are great dollar cost averages. They're great for the existing market. NVXG is 5G tech that would profit both from software and AI development. And they sell covered calls, which make it a great keeper. And I said this last week. You can pause and read this, but they sell covered calls, which is great for a volatile market because it helps juice the dividend. So that would stay on the list. It's slightly lower than my current average. So it's not increasing my average price a share. And then these two are more what I would consider long-term anchors in my portfolio, in the sense that if the market turned and we had to change currents, in the sense of inflation went up and rates are going up, and it doesn't really look like a BDC environment anymore, then that would force me to consider either staying on FSCO or selling my shares. But it would also force me to consider buying something else. So when something else is not very popular, it's always a good consideration now, even when the market hasn't got there yet. And as much as I don't think the dollar is weakening as much as reports say, the herd is not as confident as me. So when the herd hears that the dollar is weakening, it's going to push them to look elsewhere for value. And if the US dollar is weaker, they will look internationally. And so a US and international bond play works. And I'm not saying that US and international bonds would create a mainstay in my portfolio simply for being US and international bonds. But between PIMCO and DoubleLine, those are the bond gurus. And those level of funds would be the long-term mainstays in my portfolio. So unless the market just exceptionally turned one way or the other, and we hit, pendulum swing to extreme to pendulum wing to extreme or swing to extreme, those would stay in my portfolio. Would I sell them? No, like if I bought them and then the market completely turned, they would stay. And then when the market turned back, we would go from there. Right? It's always an evaluation of what's happening in relation to the micro data and the macro data and the micro data. And it's looking at it every week to find the best buys in the existing market. So it's really hard to predict what's coming. But overall, if the current or if the sensation truly changed, the rate environment changed, or we just saw a complete upheaval of policy, it would inspire and would require some type of change. It's just hard to predict it's hard to predict the reaction to an unknown change. It would be everything assessed in real time, trying to do the best thing for my portfolio and also try to explain why I'm doing the best thing for my portfolio in whatever way that is at the time. So at this time, I still like BRW and FCO as a combo. My goal, my egotistical, selfish, I guess you could say, goal was to promote both of those and advance both of those to 2,000 shares apiece, and then switch my attention somewhere else. It was to follow the data and track the data, hoping that as I pushed those to 2,000 shares, the data continued supporting that. And if the data said something else, I would follow the data. I'm not so selfish or egomaniacal as to just cast the data aside and say it doesn't matter when I make videos that I say are purely based on the data. That's not me. But so far, all of that has remained true. The data still says those are the best buys for me in this market. Now, after and I'm not buying tomorrow or I'm not buying Tuesday because we just bought either this week or the last week. Um, but if the data changes between now and the next buy, then yeah, they would stay at 1900 and I would look elsewhere because the more than sticking with it just because bonds and bonds proxies are the best buys, and more than sticking with it because I mean, I'm not an egomaniacal narcissist by any means. And more than just my own selfish measure of trying to push those two funds to 2,000 shares and then letting everything else keep up. The goal is to follow the data and let the data dictate what I'm doing because that pulls emotion and pulls me completely out of things. I have funds that I love. I have funds that I would love to acquire. I mean, PTY and DOY have been on a hit list for a while. But by looking at the data, that takes my likes and dislikes out of things and makes it just about the data, which means I have to sift the market based on the macro data and the micro data and everything in between, meso data, everything in between every week to figure out the best buys week to week, but also where I think the market's going based on that same data set. So all that to say, I'm not buying Tuesday. I mean, nobody's buying tomorrow. The market's closed. I'm not buying Tuesday. If I was buying Tuesday, I would get to finish out my hope for goal and buy the top two and close those out at 2,000 shares before I looked elsewhere. But I'm not buying Tuesday. The close second runner up to that would be PTY, simply based on price and on this description, which you can pause and read at a different time. The fourth on price would be NVXG. I mean, I already own it. It would be a great dollar cost average move. And their selling covered calls does help juice the dividend. Excuse me. I'm almost over this chess code, but it does pop up in certain times. Uh, NVXG on price, and yes, selling covered calls does juice the dividend. Lastly, really just based on price is DLY. It's a great portfolio. They do pay occasional special dividend, or really they've paid an occasional special dividend, and it is run exceptionally well. But of the five, it's the most expensive, and for that measure, it does pay the cheapest dividend. Take it for what you will. But that is the handful of funds for the week and why they're there. So as we continue to move forward, it's going to be the same every week. Look at the data, stress the data, allow the data to sift the list and to high. I mean, the targets are the targets based on discount, but allow the data to help us further sift that target list and really focus on the funds that are the best buys in this market. So week to week, it's the same strategy, it's updated data, and it's better positioning as we go. And that's really all I got. So see you next Sunday. I wish you all a great week and good luck in all of your endeavors. Have a great one, everybody. Bye bye.